Okay. Everybody hear me? Welcome. We are, I thanked Scott McNeely for setting up our venture panel with his comment that there's no risk as long as you're using other people's money. So I thanked him for that. We're very tight on time. We're here to talk about venture capital in emerging markets, and we've got an expert panel from Silicon Valley and with some insights from other parts of the world, and want to jump right in quickly into their ideas and their contents for your benefit. And hopefully we'll get a couple of questions in as well. So what I'd like to do is bring them up onto the stage. I'm going to start with Dan Senor. Dan is with Elliott Management. He's a co-author of Startup Nation, well immersed in the New York and the Israeli dynamic, and so we'll try to tap into that a little bit. Stu Francis, who is the vice chairman of Barclays Capital. Stu is going to be our authority on capital markets. Dave McClure from 500 Startups, who is one of the real pioneers in the angel, super angel wave. I'll let him determine what exact label he wants to attach to himself, which I think is a great perspective. Jeff Bussgang from Flybridge Capital. Jeff is a startup manager extraordinaire, an author extraordinaire, a teacher extraordinaire. He teaches with us at the Kauffman Fellows Program, and is now at work, has put together one of the real hot young venture brands and kind of carrying the flag for the Boston venture market. And Matt Cohler from Benchmark Capital. And unless you've been living under a rock, you would know that Benchmark is not only one of the premier brands in terms of returns, but in terms of conduct and their entrepreneur centricity. One of Matt's partners, Bill Gurley, is a regular speaker and faculty member of ours at the Fellows Program, and characterizes Matt simply as the most networked person on earth. So I set him up with that. So thank you, panel, for joining us. We've got about 45 minutes. And I wanted to kick off. I'm going to pick on Jeff first, because I know him the best. But we have a pretty deep relationship with Endeavor. We know a lot of the entrepreneurs. The entrepreneurs that come out of this ecosystem are nothing short of spectacular, not just in terms of their performance, but in the tough environments in which they work. And so, Jeff, I guess I thought it would be useful for the audience to hear if somebody does come to you from what is a fairly remote region, whether it's Latin America, the Middle East. They've got interesting technology. They've got penetration. They've built a team. They have customers. Could you walk these entrepreneurs through what it would be like to reach out to not just a Flybridge, but a Flybridge, a high-quality firm? How do you process, can you process these kind of deals? And if not, what are your priorities? What are the things are you thinking about that might prevent you from focusing on these kinds of entrepreneurs?
Yeah, so first I would say don't come to us quoting Scott McNeely and saying that you're there to burn through our money until you learn how to do the startup game on your own. No, but seriously, I think the challenge that US-based venture capitalists have in working with entrepreneurs outside the US is that the network of relationships is not as strong as they would be in Boston, New York, or Silicon Valley. And so first I would say find a way to develop a network of relationships that's connected to that venture capitalist. We're more likely to trust you if we know people and trust people who you know and trust well. This is a game of trust and relationship building. And so that's the first really important factor I would cite. The second thing is that when we invest in a company that's far away from us, we therefore have to trust that entrepreneur to be more independent. We can't necessarily build the team for them. We can't necessarily hold their hand. We can be strategic from a distance, but we've really got to know that that entrepreneur can execute without our hand-holding. And so the second thing I would articulate for you all to really think about is to prove to folks like us that you know how to execute your business, your model, in a very unique comparative advantage way where you don't need to be dependent on our hand-holding and our help and advice. You'll use it and it'll help accelerate you, but you're on your own, you're doing a spectacular job already. And those are the things that we really look for. Entrepreneurs who don't need our help, but for whom our involvement can help accelerate to a bigger vision and maybe a bigger market opportunity.
A quick follow-up to that, Jeff. If someone does gain some traction with you, personally, an entrepreneur, what are some of the steps that you have to follow to bring your partner to your partnership to a decision to invest?
Yeah, and I don't know how the benchmark team works. At Flybridge, we're a unanimous partnership, and we all get exposed to each investment opportunity. So a lead partner will do the bulk of the diligence, get to know the entrepreneur, and be the prospective board member. But at some point, the full partnership needs to be involved, needs to be briefed, and either through Skype video or ideally an in-person meeting, need to meet the entrepreneur and have an opportunity to hear the story directly and really interact and engage with the entrepreneur and see how they handle themselves when the tough questions are put in front of them. So that's a very important part of the process that many entrepreneurs have to go through. It's not just getting your champion from the venture capital firm behind you, but getting the entire partnership behind you and having the help of the champion to navigate that partnership and doing it proactively is very important.
Great. And Matt, I'm going to ask you for a follow-up in a second. Before I do that, I want to take a quick poll of the audience. Could I get a show of hands of entrepreneurs in the audience? Okay. How many of you have ever sat down, looked at, or seen any semblance of a term sheet between a limited partner who invests in venture capital and the GP who actually accepts that investment? Is anyone, how many people of you have seen that kind of a term sheet? So quite a few. Interesting. More than I would have thought. Matt, I'd ask you to maybe comment on the same questions. And the reason I ask that question is I find in emerging markets, and we operate in 40 countries, so we deal with a lot of different dynamics, but the understanding of how the venture model works sometimes lacks. And we know how hard it is to create alignment just in the US where there's sophistication. Could you talk to the questions we asked and a little bit about the importance of alignment with entrepreneurs?
Sure. Well, Jeff did an incredible job of summarizing pretty much everything that you all need to think about on those fronts, so I won't add that much. To add a little bit of color to it, he hinted at something which is really important to understand, which is every single one of these venture capital partnerships, first of all, they're all partnerships, which is a very different thing from a large-scaled operating company. And second of all, every single one of them is different. Every one of them is structured differently. Everyone has a different decision-making process. Everyone has a different culture. So there's two things that are really important for you to understand, and Jeff already said it, but sometimes it's helpful to say it again, so I'll say it again very quickly, which is the first thing you need to do is you absolutely need to have your champion inside of that partnership, and you need to understand who is the person, and importantly, it needs to be a person who's a decision maker. Who is the decision maker within that partnership who is championing me and championing this investment? And then secondly, you need to understand how that person relates to the rest of the partnership and how the decision-making process works. Jeff mentioned that his firm is a unanimous decision-making process. My firm, Benchmark, is a majority decision-making process where the majority of partners need to approve a deal in order for the deal to get done. But it's still very important for every one of the partners to meet and interact with the entrepreneur and to go through some of the same processes. So I would really encourage you to take the time to understand the people and the structure of all the partnerships that you're talking to.
And by the way, just if I may, that's not advertised on our websites.
Right, absolutely not. Right.
This is the kind of thing, again, the informal network of relationships, talking to entrepreneurs who have worked with us, talking to folks who have sat on boards with us, who have pitched us, getting those informal information elements is really critical.
It's a great and reasonable question to ask the investors you're talking to. How does this work with you people? How do you make decisions? How is that going to happen here? Because you're going to get a different answer from different places.
Great. Thanks, guys. Dave, a question for you. Maybe to take a minute and talk about what do you call yourself and how do you fit into this ecosystem, and are venture capitalists important to you? And the last question, and I'll just throw it out, is what's happening with the phenomenon with super angels and the accelerators that seem to be a key partner to you? They seem to be popping up in interesting places. Is that scalable, and if so, why?
Okay, so I think that was about
three
four questions.
Four or
We'll
five
take
questions.
the rest of our 40 minutes. So Super Angel, Micro VC, I guess let's just tackle that one first. So Super Angel is a bit of a misnomer because typically it's describing someone who is not an angel but who is investing professionally someone else's money, but investing it typically in smaller checks than normal VCs and usually in larger numbers. And if that's the definition, then we're probably the extreme case of that, in that we're investing typically $50,000 to $100,000. We've done about 150 investments in the last year, which is far beyond the scale of most sane people. And I guess the other part of your question was, how do we work with VCs? How do we see that? Yeah. So I don't think I'm breaking any SEC laws by saying that some of my LPs, some of my best friends are VCs. Some of my investors in our fund are VCs, both funds and individuals, as well as a bunch of angels and entrepreneurs. Yes, I mean, as much as I'm often quoted in the press for criticizing the venture capital profession and other folks, of course, none of the esteemed members of this panel.
It's just theater.
It's just theater. Well, actually, no. I do think most VCs are lazy bastards and live on management fees, so that's fully transparent. But, yeah, I mean, I think there is an ecosystem of smaller and larger investors, and that definitely there are areas where we do work together, and most definitely, we don't generally take board seats, whether or not we feel board seats are important. We do work with downstream VC. Where I think it's actually probably important for a lot of people in the audience is to understand what the goals of the different structures of investors are, whether those are angels, small funds, large funds, incubators, whatever, and what the exit trajectory and expectations of them are. Because that's probably where the alignment with the entrepreneur matters the most. And so if you are taking money from a large VC, you should be thinking and expecting that your challenge is to get to 9-figure exits, possibly 10-figure exits or better. My personal opinion is there's a lot more of the small exit opportunities available these days. And so generally, I think it's probably appropriate to take capital initially before the idea is fully formed or before the business model is apparent from smaller investors, and that as that becomes more apparent that there is a big idea involved, if that's the case, then potentially engage with larger investors.
Yeah. And the last question that I'd love to hear you talk about is, given that this is an audience full of Latin American entrepreneurs, Middle East, Southeast Asia, to the best of your knowledge, do you see the Dave McClures, do you see these kinds of folks down the road starting to evolve in these regions? Because we are starting to see some very high quality professional small venture funds popping up in this region. Do you think it's possible?
Much as I am an audacious bastard, I am not yet so famous to talk about myself in the third person. So I don't know who the Dave McClure is of any of those other things, other than that they're probably crazy. Yeah, I mean, I think the challenge with doing our strategy is that we actually depend on a lot of other angel investors and seed funds downstream, because we're doing a lot of investments. We expect probably a majority of them fail, but that the ones that succeed are their next round of capital is probably coming from larger investors. So in other markets, particularly in developing markets right now, there's not a lack of large VC in those markets. There are large investors. Actually, I think Benchmark and several others are already active in Brazil and other economies. What there's a lack of is the angel investor market and the seed market. And in some cases, I think really it's because of a lack of perceived exits that's driving some of that. So I think that's really the challenge, trying to do scalable investments at small check size in other emerging markets, is understanding what the angel and seed fund ecosystem looks like and how you can ensure that there's downstream capital available where it's required.
Great. Dan, I'm gonna move to you, and Stuart, I've got a couple questions, and then I'm actually going to open it up to the audience as early as we can. So if you have some questions, think about it. And I know there's microphones floating around, but Dan, given your your immersion in two very interesting, fairly young venture markets, Israel and New York, I'd like to hear you talk about what lessons some of these ecosystems may take away from what's worked there. One of the problems we see is I would say an overly zealous fascination with replicating Silicon Valley, which is quite difficult to do because it's so long in the tooth, it's so complex. Are there things you've seen happen? I mean, New York has just actually exploded out of nowhere. Israel, very strategic over the last 15 to 20 years, very successful. Some thoughts there that people could take away?
I think Israel, I can talk about New York, but I think Israel's interesting as far as, since there are a lot of people here today from emerging markets, is how does Israel and entrepreneurs in its region survive during this chaotic period, right? So I get this question all the time. There's all this geopolitical unrest and risk in the region right now. Who on earth would touch a company? And the truth is, I mean, Israel's a case study in how to persuade investors during difficult times. If you look at the 90s, you look at all the inputs that contributed to Israel's technology and venture boom, or startup boom. By the way, just to give you a sense of perspective, Europe, about 750 million people, produces about 700 to 800 startups a year. Israel has a population of about 7.5 million people and produces about 500 to 600 new startups a year. So it's just the highest density, literally the highest density of startups in the world. And so in the 90s, you had this massive wave of immigrants from the former Soviet Union who brought a lot of technological talent. You had the Oslo peace process, which gave people in Israel, the region, the world, sense of hope that there may be a sort of new Middle East, as Shimon Peres called it, of stabilization and economic integration. You had, obviously, the technology boom in the late 90s. And all these factors disappeared in the early 2000s. You had the Oslo peace process collapse. You had the wave of immigration from the former Soviet Union basically come to a close. Technology bubble burst. And yet Israel's share of the global venture capital pie right after that period basically doubled, actually, during the 4 or 5 years after all that good news had disappeared. So how did Israel do it? And there are a number of factors that we talk about in our book. I won't go through them all now. But I think two that are very important for economies and marketplaces that are trying to replicate what's happened in Israel is, one, when you look at the cluster, the economic cluster, Michael Porter's cluster, I think people tend to focus on a lot of important inputs, but one of the most important is, where do people go when things go south? And you look at, for instance, Dubai, where there's been a lot of amazing a lot of great economic stories in Dubai over the last few years. But as far as startups are concerned, and entrepreneurs building startups, what's striking is when things went south in Dubai a couple of years ago, many of those entrepreneurs just picked up and left. Many of them went back to Saudi Arabia or London or wherever they were coming from. In other words, many of them were not invested in building lives in Dubai, raising their families in Dubai, being a part of a community in Dubai. And that has been critical in Israel, the sense that these entrepreneurs and VCs are living on top of each other. Their children are going to the same schools. They're building a community. They're bumping into each other at charity events in the evenings. They're dealing with adjacent industries all day long, at work, in their communities. And even when things go bad, they're still building companies, right? 2009, 2010, venture capital dried up in Israel, but entrepreneurs are still building companies. Today, there are as many startups in Israel as there was in 1999. There's about a third of the capital chasing it, which is why it's a pretty good opportunity it's an investor-friendly opportunity. So the sense of persistence, even during downtimes, are people staying and sticking it out and building communities. And then, two, how global an outlook does the entrepreneur have? In Israel, they're effectively isolated in the region, and so every Israeli startup. You go meet with an Israeli startup, and they literally have a PowerPoint presentation, and they're pitching you, and on slide 4, they're already talking about their China strategy, right? They haven't even launched, and they're talking about their China strategy. Why? Because they have no domestic market. So they are experts at going global from day one. Now, if you're concerned about geopolitical risk, you will have much more confidence about a small company with a bunch of people sitting in a small office that don't have to depend on much else in their country or their neighborhood or their region because they're totally outwardly focused. That gives you're less susceptible to the chaos in terms of the geopolitics. The same thing right now with regard to the Arab Spring. I know a lot of investors who have been working with companies in Jordan and in Egypt, and the ones that they're basically sticking with, given all the uncertainty of the region, are the ones that aren't dependent on the local market, but the ones that are sort of going global from day one. And you even look, I think one of the most exciting things happening right now in Israel is some joint venture enterprises between Israeli venture capitalists and Palestinian entrepreneurs and investors. And there's one being led partly by this gentleman by the name of Yadin Kauffman out of Veritas, which is a venture capital fund in Israel. And it's Israeli VC mentors working with Palestinian entrepreneurs, and they're working with Palestinian entrepreneurs who are building companies that are totally globally focused. And they're just not affected day to day by whether or not Hamas and Fatah form a unity government or not. They're like, it's an alternative universe.
Great, thanks. Stu, and if we could tee up our first couple questions in the audience right now, that would be great. Stu, I guess I'd like to hear you talk a little bit at a high level on capital markets. And maybe the first question I'd like to ask you is are you an optimist? Are you a pessimist? Only because right now the opinions and the feedback on the capital markets seem to be all over the place. We've got some good news, but I just came out of a meeting an hour ago with one of the great luminaries of venture who thinks the capital markets are more broken than ever for startups. And who's to say who's right? But what's your thinking on it, and what are the things we need to do to make sure we get back to a very healthy system?
Well, I think I and we are relatively optimistic about the capital markets overall. And I'd say this, the monetization market for early stage companies is not the best it's ever been, but it's certainly in the top third of any time we've ever seen IPOs. Having done IPOs for just about 40 years, if you look back over time, there's a saying that a good company can go public anytime. But in fact, if you really look at the facts, a good company can go public at a reasonable valuation about 1/3 of the time, and that's it. If you think back to all the world events that have affected things, the crash of '87, Desert Storm of 1990, the crash of 2000, there are a host of periods where the markets are really closed. But we're in a marketplace right now where institutions want to buy growth, and there are three big trends that subsume a host of other technological advances that the market really is buying into: cloud, mobility, and social media. And if you look at underlying trends in each of those sectors, large companies are being built in many different countries around the world, and global investors are looking at each one of these trends and saying, I need to be a part of some of the new companies coming along. So you see existing companies trading at PE ratios lower than the S&P 500. I mean, the top 15 technology companies trade at an average PE right now of about 13, and the S&P 500 trades at 15. We've never seen that in 40 years. Yet, all the high growth companies that are coming public are coming out at 7, 8, 9 times revenue, 40 times earnings, because the opportunities are so big. We're in a big technology change. The second point I'd make is that the juxtaposition of a good IPO market with a very strong corporate buyer market really allows entrepreneurs to play the two against them to make the right decision for the company. The top 15 technology companies around the world have $250 billion in excess cash. It's all earning 1/10 or 0.2%. I've never been in a situation where in front of a board you can say on any deal, this deal is accretive if you use cash, because they don't make any return on the cash right now. So you have a strong desire by corporates to expand their growth. They have $250 billion of excess cash. Much of it is offshore, and I think there's a very interesting aspect related to the entrepreneurial companies here, and the people thinking about it is most U.S. companies want to use their offshore cash offshore because they can't bring it back. So you put the two together, great corporate buying market, good IPO market, and some real fundamental trends that are unfolding right now. And the institutions look at it and say, in technology, the young always eat the old, and it's happening more rapidly right now, and I'm going to be part of the predator rather than the lunch meat.
Great, appreciate it. So a couple burning questions, and I'm going to pull it back up here. Anybody questions out there immediately? Sir, the microphone. And would you mind, quick question and quick introduction of who you are, please?
Yeah, my name is Imad Malhassa. I'm the CEO of IrisGuard. We recently got an investment from the region. I'm from Jordan. So aside from Dan, who's working straight into making ecosystems in Israel, the question is for the rest. How much of your investments are outside the U.S.? And the room is full of people who are not from the United States. What are the chances of actually investing in a company in Chile? Last time I was here was last year. It says if we can't drive to it, we're not going to invest in it. So there needs to have ecosystems, like Dan has said, within those countries, within those regions. So to go back, how much in dollars percentage of your big funds are invested outside the United States? You put things that are extremely difficult for an entrepreneur to come up and sell you themselves if they're coming from 10,000 miles away. They are almost impossible. So just to give that perspective, okay?
Great, and I'd like everybody to take a crack at that question, but I know Matt, you've recently made an investment in Brazil, is that correct?
That's
and
right.
maybe you can specifically talk about that. Dave, you actually, the odds of you investing in Chile are quite high because you've actually invested in Chile. So I guess that, but maybe Matt, talk a little bit about, yeah.
Sure. So on a percentage basis, I don't know the exact number, but I know it's very, very low. And what would be required for us is really exactly what Jeff spoke to earlier, which is being driven by relationships is really important. And then when we look at the opportunity, if it's an opportunity that's not in a local market, it either has to be a company that's serving that local market, and that in that case, that local market needs to be pretty sizable, or it needs to be a company that's serving a global market. And if that's the case, there needs to be a damn good reason why it makes sense for that company to be in that country rather than to be serving the global market from someplace else. Because if you're serving the global market, you're competing with everybody else, and so there's going to be 20 companies right here in Silicon Valley that are competing with you. So why does it make sense for you to be in Chile or wherever it is? So in the case of the investment that we made recently in Brazil, which is a company called Peixe Urbano, apologies to the Portuguese speakers in the audience for my butchering of that, that was very much an investment that was driven, one, by excitement that I had about Brazil specifically. It's the world's 5th largest country by population. It's one of the world's largest economies. It has a lot of very large secular kind of thematic trends that are in its favor, particularly over the next 4 or so years. And I was spending a little bit of time looking at what opportunities Brazil might be. And fortunately, again, to Jeff's point, there's an entrepreneur there who was a colleague of mine from Facebook. And so this was somebody with whom I had a lot of mutual experience and relationships, and there was quite a lot of trust that existed there. And he was starting up a new company, and I was very lucky to be in the right place at the right time. The company's grown incredibly quickly, and it's like grown to 700 people in a little over a year, and they're, knock on wood, they're doing great. But that was a very special situation, and I was very, very lucky to be in that position. So, could that happen again? Absolutely. If there's another entrepreneur, with whom I have a real relationship, or one of my partners does, either in a market where we're really excited about that market, or in a market where we can look at that company and say, yeah, I really get why this company is in Argentina, or why this company is in Turkey, or this company is in Jordan, then sure, it could happen again. There's startups, by definition, are exceptions to rules, so if they succeed. So everything we're doing is about exceptions, not about rules. So anything is possible. That's what keeps it exciting.
Matt, one quick follow-up. Sorry, Jeff. And I'd ask you the same question, Jeff, for everybody is, do you have a sense, it's a sample size of one, obviously, with this investment in Brazil, but how much harder, how many more trips, how much more time, can you put any kind of a quantitative sense of how much harder it is to get a benchmark to close a Brazilian deal than a Mountain View deal?
Yeah, it's a lot harder. It's a lot harder. And the reason why it's a lot harder is, first of all, hopefully the investors are self-aware enough to know a little bit about what they don't know. That's questionable whether that actually happens or not. But there's a natural discomfort around saying, I'm not an expert on Brazil. I don't know what's going on in this country. I don't understand the dynamics here and the people here and the relationships here. So that creates a big challenge. And then secondly, believe it or not, most of the time, venture capital investors actually want to help entrepreneurs. We may be deluding ourselves a lot of the time, but we actually do want to try to help. And so if I'm sitting here in Silicon Valley in San Francisco and I have an investment that's thousands of miles away in a country that I don't actually know much about, how can I actually be helpful to that company, that entrepreneur? And I think, again, that goes back to the specifics of the situation. In this case, to Jeff's point again, trust was there, relationships were there, and so we can have very open conversations with one another about things that are very fundamental to any growing startup, where I can bring some of my experience and my partner's experience to bear. But in a lot of situations, you just can't find the intersection of those things. So yeah, it is definitely a lot harder to get a Silicon Valley or a US-centric venture capital firm to make an investment in a foreign market. The bar goes up a lot.
All right. Thanks, Matt. Go ahead, Jeff.
I wanted to amplify something Matt said and then add to his last point. The amplification I would say is that we don't like investing in local regional plays. So if your startup is a Jordanian local regional play, it's not going to be as exciting and interesting for us.
You're not speaking for all venture capitalists, I hope, right?
No, I'm saying for
a
Flybridge or a fund that's a large fund that may not have a strategic emphasis in that region. The other thing I would say is that there's a little bit of a first olive out of the bottle problem that you've got to get through. So our first olive out of the, now that Matt's made an investment in Brazil, he's got one olive out of the bottle. He's got a set of relationships. It's more likely now that you'll make a follow-on investment. We did an investment in a Venezuelan company based, the headquarters in Miami, but the operations are all in Venezuela, called Open English, which is doing online English language learning in Latin America. Well, now that we've made that investment, and by the way we got there was similar through relationships. The COO and co-founder was a BCG guy. I used to work at BCG. The CEO had a friend who went to Stanford Business School. My partner who led the investment went to Stanford Business School. And the chairman's an Endeavor supporter. So we had a lot of connections that made us feel very comfortable. But now that we've made that investment, we're leaning into other investments in the region. So once you've got that first beachhead, the big venture capital firms are going to be interested, if things go well with that initial investment, to make other investments in the area.
So the advice might be is go through a venture fund's portfolio, and if you see
if you're the first one, it's going to be a higher bar.
Yeah.
But if you're the second or third and you can establish relationships with the first one or with other key relationships and advisors that firm has on the ground, you've got a better shot.
Great.
I'd
Stuart.
come at it from the other side of the perspective, or the other side of the market, which is we've seen a very significant increase in international interest in IPOs, either from the U.S. by other investors or into other international markets. I would say 35% of the technology IPOs in the next couple of years will be from non-U.S. companies, and 35 to 45% of the investor interest that we see generated is coming from non-U.S. investors. So while the U.S. market is still by far the deepest, most experienced market in analyzing companies, technology trends, and where people want to invest, we've seen a very significant increase in interest, and that should drive entrepreneurial interest in other countries, and it certainly will drive venture capital investments in other countries. I mean, we have, and the market has seen a significant expansion of Asian IPOs into the U.S. We see a huge expansion of private wealth in South America that's looking for high growth situations. So I think that the harbinger of, if the money's there, the entrepreneurs will come and the companies will come is very correct and accurate, and you're going to see a significant growth, despite the fact that I think for everyone in this room, globalization is the greatest opportunity we've ever seen. And it's also the biggest hassle that you've ever had to deal with in your corporate life, because you have to do phone calls at 2 in the morning, you have to fly to Frankfurt on a 2-hour notice, and that's just the way it is now.
Dan, any quick thoughts?
I just have a quick question for Stuart. On those companies that you're seeing increasingly overseas that are accessing our capital markets, who's funding those companies? Where are their sources of funding on the front end of their life, the early stages of their life cycle? Is it all local money?
It's very much both. You certainly have an embedded group of financiers in Asia that have been funding a host of startups. You do have a number of U.S.-based venture firms that have implemented international operations. I was just with somebody this morning. They've done 7 non-U.S. tech IPOs as a partnership in the last year, and they've done 7 in the U.S.
Are sovereign wealth funds? Are you seeing sovereign wealth funds play on a deal-by-deal basis?
A little bit, not that much yet. The sovereign wealth funds seem to be more comfortable participating in larger financings for change of control transactions like Mubadala and ATIC and things like that. Because the issue they have is to move the needle in their overall returns, you need to make a $5 billion investment in ATIC, not a $5 million investment in an attractive company in Israel. But we have seen funding come from both sources. So.
Great. Dave, and I'd ask you maybe to take the opportunity, not just with your investments, but you have an interesting initiative, I believe, called Geeks on a Plane, which, you seem to be a buyer in the international markets, and maybe even by your response, you don't care if it's a global platform. So, where are you going with this?
Well, we do care. The majority of our investments are still Silicon Valley. It's probably 60, 30, 10 Silicon Valley, rest of U.S. and rest of world. But we have done 18 investments, depending on whether you're talking about geography or incorporation outside the U.S. About 5 in Asia, 7 in Europe, and then 2 each in Australia, Latin America, and Canada, if we consider that another country. Intentionally, we set up the structure of our fund to enable us to do international investing, currently out of about 8 geographies, and probably will expand that a little bit more. My wife's Japanese, my kids speak Mandarin, Japanese, English, and are trying to learn Spanish. My friends are all over the world. My partner's Korean background, married to a Chinese. One of the other hires, Indian American, and we're working with Beji Yang, who's Brazilian native. I think it's imperative if you're going to be doing international investing that you have a team and a focus and familiarity that comes from those areas. But I do think that while there's a ton of innovation still happening in the U.S., the future is probably most likely Asia and Latin America. Possibly Russia and Eastern Europe as well. But I do think there's a lot going on, not just in South Asia and East Asia, but also Southeast Asia, and particularly Latin and South America. I think if you're thinking about what are global languages, 10 to 15 years out, it's probably Mandarin, English, Spanish, and Arabic. And there's a few other geographies that I think are interesting also. So preparing for that eventuality, as an investor and hopefully as someone who's involved with companies, I think, starts probably culturally. And so we started doing Geeks on a Plane when I was still working for Founders Fund 2 years ago. My wife is Japanese, and so it was easy to sort of make some trips to Tokyo with friends and family there, some other folks in China that we already knew. Those trips kind of blew me away with what was really happening. I think when you sit in Silicon Valley, you think you're in the center of the universe until you go to Beijing. And then you realize, we're not the center of the universe anymore. And there may still be a lot of capital going on here, and I haven't been to India yet, but we will be going later this year. Really, a majority of the world's population, 3 billion people, are sitting in Asia, 3.5 maybe. It's kind of foolish when you see, growth in language, growth in GDP, growth in internet markets happening in those territories. If you're a venture investor and you're only, investing in Silicon Valley, it's extremely short-sighted. Now, there are sort of very tactical issues in understanding language and culture that are important, but if you make the right partnerships, I think you can, potentially be successful there. What's perhaps unique for us is because, we have this, relatively radical different strategy of investing lots of small bets. It's easier for us to take a lot of risk on the first bet. And so for us, doing international investments is less impactful than when you're making, maybe a 5% of overall fund allocation strategy for a typical investor. So for us, it's been, we've been pretty aggressive in doing that initial strategy that Jeff was talking about setting a flag in maybe just one small investment to learn. But I think we're probably thinking about expanding that strategy at the very least in Brazil, possibly in Buenos Aires and Latin-speaking, Spanish-speaking South America. Already working with Innovation Works in Beijing and Seed Camp in London.
Yep.
So
Great. Question? Right here, front row. And just wait for the mic. It's coming to you. Probably this is going to be the last question because we're getting tight.
Okay. My name's Rob Sussman. I'm from South Africa. My question is actually for Stuart. I'm not sure if you're aware, but I think the largest micro gaming platform comes out of South Africa. Peter Thiel from PayPal, the founder, out of South Africa as well. And I was just wondering, with Barclays' acquisition of Absa Bank, South Africa's largest retail bank, for £2.9 billion in 2005, what the strategy is, and if you actually know the strategy of Barclays, or maybe your own feeling in terms of money transfer between people, is obviously different in emerging markets as opposed to a mature market, and just wants to know your personal view on the way that will evolve over the next term.
Great. Well, I think let me start out with the sort of the broader perspective of South Africa and Africa in general, which we think, and I think most major financial institutions think, is a very attractive market. We're spending a lot of time in South Africa. Bob Diamond, our CEO, happened to be there 2 weeks ago for about 10 days. But I think we're very consistent with a host of other financial institutions who view it as a big opportunity that has yet to be developed. And so global financial firms should be able to move in and have it accelerate the expansion of sort of financial trade. There are so many new ways that money is being transferred around the world now. You look at a company like Green Dot, which is prepaid credit cards. You look at prepaid mobile phones. You look at a host of new ways to transfer money like Zoom, which allows you to transfer it from your computer at home very easily. And in our judgment, the days of sort of one or two cards in your wallet, which is a credit card and a debit card, and that's it, are sort of over. And you're going to have 4 or 5 different ways to transfer money, and it's going to be uniquely effective in countries and in regions which don't yet have fully developed financial service models, which we would put Africa in that category. So cell phones, clearly NFC communications is really one of the most exciting new developments around cell phone technology for using your phone as a credit card. I think every major mobile company is thinking about that. We've done all of Qualcomm's work over the years, and I can tell you NFC is high share of mind there. Motorola, it's high share of mind. So in our judgment, new continents that really have financial systems that have opportunities to really develop new ways to sort of transfer funds between people are big opportunities, and it's not going to be one size fits all. Does that answer your question?
This triggers a question I'd like to ask everybody, and it goes a little bit from our experience of what the pattern we see is that thought leaders, mostly people in the venture capital or investment world, tend to look at where they are and Silicon Valley, and just recently maybe a little bit at China. But what do you do for your companies that are overseas? A Brazilian company, how globally do they look, and how much opportunity do you think there is for Latin American startup in the Middle East or vice versa? Is that just spread them out too thin? How should they be thinking about all of this energy that's kind of springing up around the world?
Well, Peixe is a company that's focused on the Latin American region for sure. They're live in 60 cities in Brazil and in Spanish-speaking Latin America, definitely going to expand further. And in terms of what we try to help them with, it's not all that different from the companies that are in Silicon Valley, which is around advice and networks and relationships and hiring. They're hiring, by the way, so if anybody knows great product people or engineers here or elsewhere who are interested in Brazil, please shoot me an email. I think that's a case-by-case basis, but in the case of that company, it's a large enough region and a large enough opportunity that we think it's still pretty well aligned against our objectives, to your earlier point around aligning interests and objectives, in saying this is a company that can potentially be a multi-billion-dollar company. And if that's not the case, then a U.S. Silicon Valley early-stage venture firm is probably not going to want to pursue it. But those opportunities do exist in some of the larger emerging markets, and I'm personally really excited about Brazil, but there are others.
Yeah.
I think one way that you might want to be looking at it is in terms of regulatory environment, which typically follows country or continent, currency, language, and then back-end platform. That's the one that most people don't think about. So actually, some of the issues for startups in Latin and South America are actually quite similar to the US and Europe, typically because the back-end platforms are mostly the same. So Google, Facebook, Twitter, YouTube,
Amazon Cloud,
Apple, and Android. However, they're quite different in Japan and China.
Right.
In certain geographies, there's local commerce providers which are different and mobile carriers which are different. But I do think it's important to look at, regulatory environments are starting to, get into larger mega groups. Languages, I think, over a longer time frame also are starting to be, into 3 or 4 major groups, although they're still, obviously important within regional centers.
Good. Let's ask everybody to take 30 seconds and leave the audience with your final and best nugget of wisdom as they think about their capital needs. Speak as the Spirit moves you.
I'll start. Raise capital when you can, not when you need it. And if you have a great idea, having enough capital is critical to getting there.
I would say, echoing something Scott McNeely said earlier, if you're going to choose an investor, choose very carefully. Check their references as thoroughly and do as much due diligence on them as they're doing on you. It's a mutual relationship.
Yep. I'm not sure I have much to add to that.
I guess, some of the things that we're trying to look at right now that we think are international in scope are using iPad devices for education for kids 0 to 7. I think a huge opportunity to create great new business, which typically isn't addressed by entrepreneurs. Usually there's a lot of single male entrepreneurs. They don't develop for families and kids very often. But that's an incredibly large market. At least last time I checked, 50% of the market has children, possibly even more than that. And those monetize really well. So people will pay for education for their kids. And a lot of that is now being driven outside traditional school environments. So I think education and applying that around the world is a really interesting category to go after.
Danny, final thoughts?
Yeah, and the part of the world that I'm focused on, which is Israel and the Arab world, as I said at the beginning, one, convey that you're not going anywhere, no matter what's going on, that you're there to build your company and build your community, and the two are interconnected, and you're sort of plugged in to both and sort of make yourself indispensable to both. And two, at the same time that you're sort of domestically focused in terms of being part of the local community, just be focused on reducing as much geopolitical risk in the eyes and instability in the eyes of investors by projecting that you are globally focused and not disproportionately dependent on the local market or the markets of the region.
Good. Just a final summary of what I think we heard today that I think is useful. For those of you who I met in Miami at the summit 2 years ago, I can speak, and I think there's some evidence here, but for those of you looking for capital in a place like Silicon Valley or Boston, even 2 years ago, the dynamic has drastically changed. It's still very hard, as Matt said, but it's actually kind of realistic, where even 2 years ago, I think it would have been very difficult, and that's how fast things are moving. So it is trending up, but it's still very hard. I would encourage you to remember that venture investors are creatures of behavioral habit and relationship habit. They're going to be they're going to watch everything you do, and they're far more interested in who you know and how you behave than your slides on strategy or finance. They tend to figure that stuff out pretty quickly. So don't underestimate the importance of consistency and how you deal with people and build that trust. Trust drives everything. And the drum I beat a lot is just remember that an investor is a partner. Dave has a business model. He has a family to feed. So does Jeff, so does Matt. Understand their business. And I won't tell you what questions to ask, but I will advise you, if you get a meeting with an investor, call someone you trust in the investment world and tell them and say, what questions should I be asking and why? What do I need to understand about this? The better you align yourself with those investors, the far better your chance of having success in building your company. So those are the final thoughts. I'd like to take a moment to thank the panel for their investment of time and energy in this, and thanks for your questions. So wrap it up.